While everyone is busy debating whether AI is coming for their job or dissecting the latest billionaire drama, the global financial system is quietly rewiring itself. This chart tracks the US dollar's share of global reserves. Back in 2000, it sat at a dominant 71%. But follow the line to today, and you'll see it has fallen below 58%, hitting its lowest level since 1992. Yet you don't see sweaty anchors panicking on financial news networks. The silence is deafening because this decline has been methodical, happening entirely in the background. To understand the stakes, look at what being the global reserve currency actually does. It forces other countries to hold dollars to do business, giving America access to the cheapest capital on Earth. It is an arrangement that saves the U.S. economy over $200 billion every single year. A payment from Brazil to China routes through a New York correspondent bank. This hub gives the U.S. three advantages. First, intelligence, tracking global data. Second, investment, forcing nations to buy U.S. Treasury bonds. Finally, jurisdiction, the physical ability to block any country's transactions. In 2022, the U.S. and its allies used that power to freeze roughly $300 billion in Russian sovereign assets, effectively severing the country from SWIFT, the primary messaging network for international banking. Watching that happen sent a very clear message to every central bank on Earth. The financial system they rely on to survive can be switched off at a moment's notice if they cross Washington. That realization forced them to start looking for backup plans. Building an entirely new financial infrastructure requires intense political cooperation. In 2024, the BRICS coalition expanded far beyond its original members, pulling in major economic powers like Saudi Arabia and the United Arab Emirates. This expanded group now accounts for more than a quarter of the entire global economy and nearly half of the human population. One emerging market economy cannot bypass Western infrastructure on its own, but a bloc of this size has the capital, the natural resources, and the trade volume to physically construct a parallel system. That parallel system includes a blockchain-based settlement tool called the unit. Moving into an operational pilot in January 2026, it is specifically designed to bypass the US dollar by providing member nations with a completely neutral unit of account. It achieves this neutrality through its backing. 40% is pegged to physical gold, and the remaining 60% is tied to a basket of local BRICS currencies. Its immediate tactical goal is to serve as a new measuring stick for pricing global commodities. Currently, the dollar is baked into the price of nearly every raw material on the planet. The unit exists to break that monopoly on price discovery. To actually move this value, countries are looking to mBridge. It operates as a physical plumbing, allowing international banks to trade directly with one another, entirely skipping the traditional correspondent banks in New York. When you combine a neutral pricing asset with direct settlement pipes, the three structural advantages of the old system, the data intelligence, the forced debt investment, and the jurisdictional control, are completely bypassed. We are already seeing the physical symptoms of this transition. Since 2022, global central banks have been buying up gold at the fastest pace in modern history. Trade flows are also rerouting. Brazil and China are settling bilateral trades in their own local currencies, and India recently completed its first purchase of UAE crude oil using Indian rupees instead of dollars. Even the deepest foundations of the energy market are shifting. For 50 years, Saudi Arabia and the United States have operated under a framework where oil is priced and traded exclusively in USD. Now, Riyadh has openly discussed accepting the Chinese yuan for its oil sales. People often assume the dollar will only fall if a single unified competitor, like the yuan or a theoretical BRICS coin, rises up to directly replace it. But monopolies aren't killed by a single replacement. They are killed by optionality. Historically, countries held the dollar because there were simply no other liquid markets available. Now, for the first time in over 80 years, the rest of the world actually has a choice.